This market is down in the triple digits, about 180. Scott Jacobson is here, Chief Investment Strategist with Capstone Sales Advisors. Doug Roberts is with us, a founder and Chief Investment Strategist with ChannelCapitalResearch.com. Steve Gross, Principal and Co-Portfolio Manager at Penso Capital Markets. Gentlemen, it is good to have you on the program. What do you attribute today's weakness?
Well, I think generally the market has been very overbought at these levels. There's naturally going to be people that want to sell out at these levels. The real test for the market hasn't come yet. This is a classic pullback. The real test is still to come.
You think we're going to break through the March 9th low?
It's very possible. A lot of people are talking now about how the market's much better now. The economic indicators are looking better. People forget that in 2001, the global economic indicators turned up very quickly. But in 2002, we made new lows, 22% lower. So the idea that economics are better, the stock market is better, is not necessarily connected.
Yeah, but in 01, the market had not priced the end of the world. At 6,500, we were pricing the end of the world.
Well, that's a point of view. A lot of people will argue that there's still much to come. Credit cards, real estate, there's a lot going on that maybe has not been fully thought out, has not been fully priced in, and there's a little bit of hope that things don't get much worse.
Now, this is the biggest three-day decline since March 31st, but you have to remember that it's on the heels of all the gains that we saw preceding 9 weeks.
Absolutely. Reality's starting to set back in. With regard to what Mark's saying, you also have to realize that back in 2001, you had the mortgage equity withdrawals, which pumped up, actually, the economy. Without that, you would have said sequential declines in GDP and a very, very weak recovery over the next 4 years. So essentially, and if you look at tech stocks, which were the source of the bubble, they still aren't at the levels that they were at the top of there, and they're actually only slightly ahead several years later, 8 years later, from that 2001 high. So what you're talking about is, the question is, if you believe the market's going to come back, what's the next thing that's going to bring us out of it? Back then, it was really the financials that took over leadership from the tech. The question is, what are we going to get that's going to get growth in this area? Are you talking alternative energy? I don't think that's going to be it. So therefore, the next leg that I think Steve was talking about is going to come when people start realizing that there may be a recovery, but it's not like a recovery we've seen in the past. It's a much slower recovery, and then multiples become more important.
Well, there's no question the character of the recovery is very likely to be different than anything we've seen.
And new leadership.
Yeah.
Let me get your thoughts on all the new stock and bonds coming to the market. I'm looking at a report from trimtabs.com, and the question they're throwing out there is, will the stock market choke on $30+ billion in new shares set to price this week? New offerings rocketing to $23.7 billion in April from $28.7 billion in May. So what are you seeing in terms of all this new supply?
Well, I think the market has been ready for it, and it's coming in financials in particular. They've been waiting for a rally, and as soon as the market ticked down a little bit, the secondaries started coming to the market. But if you look at the multiples these stocks had, they were all priced well below book value, really anticipating equity coming on in some fashion or another, whether that's conversion of existing subordinated securities or new issuance. I think the market's being ready for it. More interestingly, I think, is the supply coming from the U.S. Treasury and all of the bonds being auctioned by the government, and the Fed is buying them as fast as they can to hold interest rates around the 3.15, 3.25 level.
One of the things the market was talking about.
We don't have time for. Hold that thought. Sure. We're bringing you back in the next half hour, so you'll have a chance to share that with us the next go-around.
Thank you, gentlemen. We'll see you at 3:30. We appreciate it.
Chief Investment Strategist at Capstone Sales Advisors, Doug Roberts, founder and Chief Investment Strategist at ChannelCapitalResearch.com, and Steve Gross, Principal and Co-Portfolio Manager at Penso Capital Markets. And Steve, I cut you off when we last saw you a half hour ago, so now you may inject your thought.
Sure, thank you. One of the things we were talking about a little bit earlier was government policy. And one of the things we've been telling to our investors was that we're moving from checkers to chess, where we had a two-dimensional macro world of valuations and economic trend, and now we have chess. We have economic trend, valuation, and government policy. And that changes a lot of the way you have to think about risk-reward in a lot of asset classes. One of the things you were touching on earlier, how does the government come into all this and how does that affect things? It has a very significant effect, and that's one of the reasons we have to be cautiously pessimistic and careful about what we do at this levels and in different asset classes.
So is that translated into, I'm not going to be investing in heavy regulated industries? What's the practical ways to invest as a result of bigger government?
Well, what we think is that you have to look according by asset class, where you could see a scenario where commodities could do something very different than equities, or bonds can act very differently than stocks, versus the way you're sort of used to given the macro playbook historically. So it's more a question of saying, you know, what might not do what we're used to it doing given a variety of other factors, and thinking about it that way rather than saying regulation versus non-regulation in a given industry.
There's another thing that's happening in the stock market as well, very much related to that, and that is that correlation is breaking down between stocks. We've just come through a period of 6 months where all stocks really traded together. The market moved up and down quite heavily. A few weeks ago, we started seeing sector rotation, rapid sector rotation, and now even within stocks, stock picking is much more important. But we're still in a volatile market, so it's not so easy just to say buy stocks or not buy stocks. You got to say, what sector do I need to be in? What stocks do I need to be in? And I need to be able to trade them quickly because of the high volatility.
What's going to be the new leadership? You mentioned leadership earlier, but in any change in a market environment, new leadership happens, right? So what do you think?
I think right now that depends on where we're going. Right now, what we're finding is it's really just re-liquefying the system. And then right now, I think the government's looking. It could be government industries. It's really following the money. Kind of what you're seeing is you're seeing a liquefaction. You're seeing fiscal stimulus. You have to really go to the entities that are going to benefit from that type of a situation, and it's uncertain. But the one thing that we have to realize is this so-called Fed put, this so-called government put, it's not a free passer situation. It's not something where there's going to be a benefit without any cost. You have to be very, very careful for second-order effects, unanticipated consequences. What we're trying to do is inflate a new bubble to really take over from the old one. Really it was the credit bubble that took over from the tech bubble. Now they're trying to create some type of a government-type bubble in terms of alternative energy, but there's uncertainty because right now the question is, how do you pay for that?
What's the government bubble?
That's what they're trying to figure out. I don't see one right now. I just see you may have some things in alternative energy. Ultimately, what I think it's going to do is once you hit a new low, it's going to go back to the old days of true value. You're going to see a lot of the old Ben Graham type situations where things are trading for cash on the book. A lot of things with high dividend yields, but are cash dividends, not dividends of companies that are benefited from. That's ultimately going to be the resolution.
Same question, all three of you. I'll start over here. I keep hearing the Chinese are stockpiling. And some people are saying, don't believe the oil market because the Chinese are stockpiling. Don't believe the copper market because the Chinese are stockpiling. But doesn't that kind of overlook, if the Chinese are stockpiling, wouldn't it be a sane investment policy to kind of follow along? Because they're going to be continuing their demand for these miscellaneous items?
Well, China has really, piled on a lot of stimulus, but they had a lot of half-finished skyscrapers that they needed to complete.
And they half-finished skyscrapers everywhere.
Yes, but China had a lot. China was really building a lot. They were in the middle of it, and it's really, on a relative basis for their economy, not that hard to do it. Remember, the commodity markets are relatively small, so it doesn't take much movement by China to really do that. But I think that just following their lead and trying to buy into it, that's a trade, that's a commodity trade. But along these lines of bubbles and government bubbles, there's a lot of money in the system. There's a lot of money to hold inventory in oil and commodities because money is cheap. It's cheap to hold these commodities.
Let me repeat Maria's question. Where is this bubble?
The bubble
what bubble is the government creating?
All assets, all asset classes, trying to stop home prices from falling too far, trying to stop the stock market from falling too far.
You think housing is in a bubble right now?
You're deflating it is what you're saying. That's not a bubble. It's a long choice of words.
The Fed is targeting 10-year rates to around 3% to try to keep mortgage rates low enough so that houses will trade without trading at lower prices. They want them to trade at current prices, keep these mortgage assets on the bank's books where they are. It's not a bubble, but it is inflating asset prices. You're trying to, with money supply, as long as there's not real inflation. The trick is cutting it off before it gets out of control.
Well, the big bubble today is the bubble in politics, which is doing really well, and it'll probably continue on for some time to come. On the China issue, it goes back to chess versus checkers. Because China's getting involved, it creates a chess scenario. Is it possible, because of China's demand, that even if equity markets have a downturn, that commodities may hold up better, given what China's doing? Yes, it's possible. That's why we think you have to think about that. You got to start thinking like chess. In exactly this kind of scenario with China as an example.
I wonder if it's actually really going well. I mean, for the first time in my career, what I'm hearing the conversation target is the game rigged? Are we looking at too much intervention? Are the rules changing in the middle of the game? And how do you have trust in a system if you're not sure if the rules are going to change in the middle of the game? So I don't know if it's going well, as you say, from the government's
I think that's one of the key problems we're talking about. Going back to China, you're talking about essentially driven, non-free market economies. So they change the rules quite frequently in the game. Right now, you have something similar with a lot of the government intervention. You don't know what the rules are going to be in the future. So therefore, if you're making a decision, you've got to be very, very nimble as to what goes on, because the rules may change in 3-4 months.
Okay.
Gentlemen, thank you.
Nimble we are. Thank you very much, gentlemen.
It's like